you don't have to be super creative or take unbelievable risk or hit the lottery in order to build the kind of wealth we're talking about here. Well, everything that we're talking about here was built on a solid job, one company, 25 years. I've done very well at that company. That company has been great for me. But this is just spending less than you make and investing the difference and doing it all the time, no exceptions. So that's been the mantra we've used for 25 years, and normal people can do this. Yes, people are going to have incomes that vary. Not everybody's going to have the same level of income I did, but everybody can do every other thing that I did. And whether you got the same income level or not, you can get to wealth levels that will surprise you if you just start this early on.
You're listening to the Millionaires Unveiled podcast, where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their current portfolio allocation. Now to your hosts, Clark Sheffield and Jace Mattinson.
What's going on, everybody? This is Clark. Welcome back to another episode of the Millionaires Unveiled podcast here with Jace. Jace, what's going on? How are you?
Doing all right, man. Just having a little heartburn with these interest rates on the mortgages, man. This is unprecedented territory we're in right now. It's nuts.
Yeah, really. We're recording this on the 16th, so June 16th, and I got a notification from the Wall Street Journal. It says the average rate for a 30-year fixed mortgage hit 5.78%, the highest level since 2008. Crazy that a year and a half, 2 years, 2.5 years ago, people were getting 2.6%, 2.5%-ish or so.
Yeah, no, I think you're spot on. We had an unprecedented run of low rates for a very long time, and then obviously with the surge of housing and housing demand and housing shortages, new homes construction mainly, it's been crazy watching values just skyrocket. And now we're seeing just the opposite, and just a almost flip of a switch as the Fed's been forced to try to raise rates to curb inflation. So yeah, I mean, if you're going to get a mortgage today, you're looking 30-year, you're looking at high fives, low sixes probably, which I don't know that I thought I would see at least in the short term in my lifetime. I mean, my parents used to talk about these mortgages back in the day, like 8 and 9%. I thought that was like, something in the history book. But we may be staring at it pretty soon.
You'd never see again, right?
Yeah, totally. And you know what's wild?
NASDAQ is down 33% year to date. The S&P is down 24% year to date.
Yeah, and tech, I think, has been kind of leading that. You know what's wild is I was thinking about high yield savings accounts. Man, I haven't got a big adjustment for my Marcus account in quite some time either. Back upward. I don't know if you have.
Really kind of makes you mad, right? It's such a scam. They're so quick to like suck it in and then suck you in on the money and then drop your interest rate, but then things start going back up and you never get an increase.
It's another interesting phenomenon. I read this thing the other day that was kind of about we've had this millennial surge, right? All of us millennials, I'm one of them, you're one of them, age-wise, that have kind of entered the workforce and the market and gone through college, mainly post-2008. And so we haven't had these experiences. And granted, every recession brings some amazing businesses. And so we've had this big surge in the Ubers and the Lyfts and the food delivery and all this thing. It basically said that, hey, you've been getting food delivered on XYZ app, getting your driver to take you to this place, getting this delivered, that delivered, XYZ subscription with these different companies and whatnot. It's like that; those days are over. Now you're going to have to start paying the real cost of what things cost, because those companies have lost a combined $15 billion in net cash. That's not even in publicly traded value. That's just in cash that they've lost this year alone. So interesting times.
Yeah. Yeah. All right. Well, we got a good interview this week with Adam. He works in health insurance industry, has been with the same employer since he graduated college. So that's something that we don't hear about very often anymore. In his 40s, net worth of $7 million, 1.5 in retirement, 1.5 in home equity, 3.5 in a taxable brokerage account, and then other stuff, 529s, HSAs, etc. Last week we had Mike. He's been in sales most of his career, net worth of $4.5 million, paid for a house, a little bit of cash in the market and in the stock market. So good interview with him last week. If you have a question for any of our millionaires, especially with some of this market volume volatility. I think it'd be interesting to get people's takes on it. Send us an email, millionairesunveiled@gmail.com, or go to our website and hit the tab Ask a Millionaire, and we'll get your answer or get your question live on the air. So thanks for tuning in. And without any further delay, let's get into this week's interview with Adam.
And you want to just give us a little about your background and what you're up to now?
Yeah, sure. So, name's Adam. Live just outside Nashville, Tennessee, a little town called Franklin. I'm a Tennessee boy. Lived here my whole life. Upper 40s. I'll keep it at that. I'm not 50 yet. Upper 40s. Now I'm 47. Married and a couple of kids. One just finished freshman year in college. The other is a sophomore in high school. So I worked for one of the big health insurance companies and have been there my whole career, coming up on 25 years next year. So what I'm up to lately is working from home all day, every day. So I'm pretty excited about things opening back up a little bit. Maybe I can get back in the office here, at least to some extent, fairly soon.
Awesome. And what is your net worth today?
Just crossed the 7 million threshold in the last couple of months.
Holy cow. So how is that broken up?
Yeah, I'll give you a little bit of a breakdown here. So this is a fairly boring breakdown, but no mortgage on the primary residence, and with what's been going on around here in the real estate market, that primary residence is probably in the 1.6 to 1.7 million range at this point. So a fair amount tied up in that, but no real estate in addition to that. Then I got probably about 1.5 to 1.6 million in retirement accounts. Bulk of that's, with my 401k, and then a little bit in a cash balance pension, a couple $100,000 or so in IRAs, for me and my wife. Almost none of which is in a Roth IRA. It's almost all tax deferred. So we'll probably touch on that a little as we go, but then the bulk of the rest of it is just in taxable brokerage accounts. So about 3.5 million or so in that type of investment account, a little over 2 million at Fidelity, which is heavily equities, roughly 1 million at Vanguard, which is a little more of a mix of equities and tips and muni bond funds and things like that. And then probably about 400,000 I've got with a financial advisor. Some of that in private placement REITs, the other portion of it in mostly fixed income, safer stuff through a Schwab account. So that's the bulk of it. Rest of it's HSA in the $75,000 range, probably about 50,000 in cash savings, and then about 175,000 in a 529 for my daughter, which I don't really count as my asset. I've told the kids that the 529s are theirs. It'll cover school, and whatever's left is theirs. So I don't really consider that part of my pie anymore, and hoping to get them off to a good start and start their lives debt free.
That's awesome. So first thing goes through my mind is you can't get rich working for somebody else, and you've done it.
I have done it. And a great employer. I mentioned 25 years at the same place. So I literally graduated from college 1 month, started work the next month, got married the following month. So I got all that kind of out of the way, in just a 2 to 3 month period, right after graduating from school, and have made a career there. So have worked with great people, for great people. I like but it's probably more like 8 3-year careers or 5-5-year careers. Seems like about the time something gets dull, I'm moving into something new and exciting. So yeah, you can that's a rarity these days, but you can do it. You can stick it out if you're disciplined and willing to spend less than you make and start early and stay after it. You can do this without being terribly creative. I certainly don't consider myself terribly creative, but you can make it work.
Totally. So let's get into the allocation here a little bit. The money that you have invested in the market, whether it's tax protected or not, is that primarily in stocks, bonds? What's the makeup there?
Yep. It's roughly 60-40 equities and bonds, which that has changed a fair amount over the last, I would say 3 or 4 years as the balances have grown. I've sort of pulled back from the equity exposure, which I know I've left money on the table doing that, but it at some point, I start to feel a little more focused on preservation as opposed to growth. So it's roughly 60-40 in equities. Now within my equities, I'm fairly well diversified as well. So probably, 80-20 domestic versus international. The domestic stuff is probably, last I looked at it, it was roughly half large cap and quarter mid cap, quarter small cap. So that's a pretty aggressive allocation within the equity bucket, but the overall equity allocation is probably a little on the conservative end. So I'm trying to right size that a little bit. I think in my opinion, sort of over course corrected a little bit there. And And now as I just think about longer term growth and, legacy planning and things like that, I think I'm probably going to end up tilting a little more toward equities in the near future, just as additional investment opportunities come up.
Has your allocation always looked similar to the way it is now?
Yeah, no, it hasn't. In fact, I tried to look back at this, although my record keeping skills are not great. So I was looking back, as much as 10 years ago, sort of 15 years ago, to see what it looked like when I maybe first crossed the 7-figure threshold. And even as recently as, 10 years ago, it was more like 80-20 equities. And my guess is if I could go back further than that and reproduce the records, it's probably more like 90-10 equities. So I have definitely moved it more toward a safer allocation as I have aged, as I'm getting closer to, what I may consider early retirement here at some point in the relatively near future. And just as the balances have grown and I've been quite as a little more about preservation. So it's probably moved from 90-10 to 60-40 over the last 15 years. It is a rough estimate of how things have gone. The other thing that I would mention here that might be a little different, and I think this should be doing it differently, is I'm heavily tilted toward equities in my taxable accounts, and pretty heavily tilted toward bonds in my tax deferred accounts. So I know there's different schools of thought on that, but just for tax management purposes, if nothing else, that's helping me sort of manage the amount of dividends and interest that are being thrown off there, where a lot of that's accumulating in the tax deferred account for now, and most of the equity exposure is in the taxable accounts.
So, Adam, let me push you on the allocation, the 60-40. You said you used to be 90-10-ish. Yep. So at $7 million, I mean, let's call it 5-ish liquid, right? If we take out the house and the 529, why not be more into equity? And by equity, I'm saying just like index funds or actively managed mutual funds, knowing that if there was a big market correction, you still have $2 or $3 million.
Yeah. Well, that is how I'm starting to think about it more and more as the balances just start to get bigger. So I actually, until I sat down and put numbers to this allocation, I didn't know that it had tilted back quite that much. And part of it, I'll tell you, part of it was driven by what happened, a year or so ago. I was more heavily tilted toward equities. When we had the big downturn, I ended up funneling money around and trying to take advantage of the upswing there, but I kind of played it too safe when I did that, and then I was kind of back to where I started. I ended up pulling back, so I should have just let it ride from there, and I would have come out much better. So made up losses, but certainly didn't take advantage of the upside that's happened, since then as much as I could have. So I do believe that is an opportunity for me and something that I need to be thinking differently about in my portfolio. I've got to get over the fact that, a 30% downturn here, we're talking about, $1 million downturn, right? That's hard to stomach when you just think about the big number. But on the other hand, it means there's still a couple million in equities, right? I mean, it's not like it's, the entire balance and long term. I know what will happen here. That's how I've gotten here. So, improvement opportunity there, I do think is, the next few years go by and I'm still working and adding to my investments, I will slowly start to chip away at that. And I've got great opportunity to do that because, as I mentioned before, a lot of the fixed income stuff is in my 401k, which means I could easily flip it to equity exposure and not even create a tax event for me. So I'm ready to do that. Market at all-time highs is one of those things that I have trouble with, just like everything else. So, when's the right time to do that? Well, I've missed that right time, 5 times over the last 6 months or so. At some point, I will pull the trigger on that, right. And that'll be how I think I right-size this allocation a little bit.
Yeah, no, I mean, it's easy for me to sit here behind a computer and say it because I'm not the one looking at my bank account balance going on 1.5 million when there's a turn down. So yeah. It's just interesting to think about overall. So let's talk cash. You have about 50,000 in cash.
Yeah.
So how come so little? Just because you have so much in the market that's accessible if something really were to happen?
Yeah, that's my logic there is that I do have enough even outside retirement accounts that's in fixed income that's, I can pull it out at any time that I need it. So I'm kind of thinking about the 50,000 is just my immediate, cash reserves, but could easily get it. Whatever else I might need through just the taxable account, the fixed income portion that's sitting in the taxable accounts.
Right. So when you make money now, you get a paycheck. Where does it go? Does it sit in that cash first, or do you just throw it right into a market account?
I just throw it right into a market account. So that's how I've built up those balances, significant balances at both Fidelity and Vanguard, just depending on, kind of how I'm feeling about allocation and where I think I'm a little underweighted, as that money comes available. I'm shifting it there. Over the last year or so, I've been moving a little bit more toward my toward the financial advisor, and we can talk about that a little bit as well. I do not have a lot under management with him, but he helps me a lot just think through overall allocation. So I've also been kind of funneling money his way. That's where I guess you would say a little bit of my, if there is such a thing in my portfolio as an alternative investment, it's sort of sitting with him. A little bit of private placement REIT, a little bit of just market hedge kind of stuff is in there. So I also pushed some of it that way as well.
So when did you start taking the cash and just putting it right into the market? I just ask because I think there's different approaches on cash, right? You can either hold for an opportunity, you can hold because you want a bigger emergency fund, or you're saving to buy a house or something like that. I mean, at what point, either net worth wise or cash balance wise or income wise, did you say, okay, now I'm just going to take all my excess cash and invest it in the market?
Right. For me, it was probably more about when I reached certain events or crossed certain, goals or milestones. So, for example, when we moved into the house we're in now, which we've been in for about 7 years, I was piling up cash in advance of that because I wanted to pay cash for the house. So the cash balance was growing there. And, once we got beyond that threshold, I didn't feel like I had a need to be piling up cash much anymore, because from this point on, the next house is going to be a downsize from here. It's not going the other direction. So I didn't need to be building up, those reserves as much as I did before. And I have never, I've finally convinced myself, probably, 15 years ago or so, that I was as bad at market timing as everybody else. So I just started investing it when it was available and just quit sort of thinking about, I'm going to sit on cash until I think the market is valuing, and then I'll put it in there. I miss that all the time, just like everybody else. So I just decided when it's available, I'm putting it in. Now, as I say that, I've had trouble with that the last year or so. So as I've tilted my allocation this direction, I guess I now think that I am a market timer. I'm having trouble tilting it back that far with the market continuing to just rip through new all-time highs. But that's sort of been the logic, for most of my investing life is don't try to time the market. Money's available. Put it in the market. Over time, you'll be pleased with the results. And I have been.
Yeah, good. So let's talk about the house. 1.7 million, fully paid off, right?
It is.
Okay, and I think Jace, correct me if I'm wrong, I think that's probably the highest paid for house we've had on the show. What did you buy it for?
Yeah, probably just over $1 million in the house. So we've had huge appreciation in this area in the last, we've been here 7 years, and we got a good deal on the land, and I think did quite well on the initial build, but the appreciation the last, year or so has been ridiculous, and sort of has driven it up into this range, which creates other challenges, right? I mean, now you got capital gains tax to worry about that I never really thought I'd have to be even thinking about on a primary residence. So yeah, it's sort of, it's reacted differently. The house values in this area reacted differently than I was anticipating, which is a nice problem to have as well. Of course, the issue at this point is, as much as I have tried to convince my wife it'd be a great time to sell, we love the area, and everything else is just as expensive now too. So I don't know that it would do us a whole lot of good to sell and move down the street and just buy at the peak there. So yep.
So does any part of you say, "Gosh, I've got so much equity in the house now"? I mean, you just talked about thinking about selling, but
absolutely. So I don't know when this will be, but at some point over the next 5-7 years, as the kids get out of school and through college and aren't coming back home for the summers and things like that, a downsize is no doubt within our future, and I'm looking at that as not only a way to reduce expenses heading into retirement, but also free up another, I don't know how much. It'll depend on where we end up going and what we end up buying, but probably, at least another $500,000, probably $750,000 of investable assets through that downsizing, that we can then invest and help fund longer term retirement and legacy planning as well. So that's coming. Not sure exactly when, and part of that will just be convincing my wife to move because she loves the area so much.
Adam, do you have plans to retire early at all?
Yeah, I do. And then the next question is, what do you consider early? When is that? And that's where I start to lose any real definition around that. So I've often thought that I would probably retire around 55. And of course, that's one thing to say that when you're 38 or 41, and now I'm 47. 55 doesn't feel like that far away anymore. I've got some soul searching to do to figure out whether I'm going to be able to, to live with myself and feel the days after that, because I do enjoy my work and take it seriously, and I'm just not the kind of guy who's going to be able to sit around and watch TV, and I don't even golf. So something has to be resolved there for me, and I get that, but yeah, I anticipate an early retirement. I would be shocked if it's before 55, but we'll see what happens over the next few years.
Did you plan to get to this level of wealth?
Absolutely not. So, did not grow up in a wealthy household. Always have been around, folks who treated money with respect and were disciplined savers and not big spenders and living below. I grew up with all of that, and to me, that was the path to get toward a comfortable financial base. But never expected to get to this, to this level and realize how blessed I am and realize how much help I need to try to figure out what to do with this from here on out. Because, it gets to the level where you realize that the do-it-yourself or attitude that got you here and sort of the disciplined way of doing it might need to be reevaluated a bit, not some radical change. But I never anticipated getting here, at any point.
Do your friends or coworkers or family know of your wealth?
No, I don't think so. I mean, obviously, live in a nice house, drive nice cars, hang around friends that have, work in similar businesses with similar jobs and things like that. But I don't believe most of them know that. I mean, my very close family, for the most part, isn't aware of that. Getting to that interesting point in my life is a grown teen. He's in college. Before you know it, he's going to be out on his own. And I'm thinking about things like, who's going to be the trustee of our family trust and things like that. So I find myself having conversations with him, that I never really anticipated having at this point, because I feel like I have to, because I got to make sure that folks are aware and are prepared if something was to happen and that sort of thing. But no, for the most part, we really don't live like someone that would have this level of wealth. We do have a very expensive house, and we drive nice cars, and beyond that, we live pretty frugally, actually, shockingly frugally on a number of fronts. So.
And your kids now, are they aware of the value of the wealth, or is it more of, hey, I've just got some money down the road, we need to have some more discussions and have some big boy conversations that maybe I didn't have with you when you were a teenager?
Right. Yeah. My son is just starting to be let into the details, to a small extent. It's interesting, at that age, I'm still not sure that most kids have fully grasped what some of that means. So I'm not even, it's just a number probably to some extent to him, but we've kind of talked through, here's the major buckets. Here's what you need to be aware of. Here's who you would need to call to get help with this. Like, nobody's expecting you to figure this out on your own. Here's the financial advisor, here's the estate attorney. You call them if something happens, and we trust them and they're going to talk you through it. But, just enough to feel like he's not going in totally blind is sort of where we left him. But different place, obviously, with my daughter. Haven't quite gotten that far yet. But that's one of those things that I think is going to that's going to evolve over the next, 3-4 years as they get through school and get out on their own. I'm sure we'll need to have some more transparent conversations around this.
Yeah, totally. So as you were going through this journey of becoming millionaire, then multimillionaire, how long did each of those kind of pegs take you to get there?
Yeah. I, again, was trying to go back through my records to make sure I was thinking about this correctly, track to this, but I'm pretty sure that we crossed the 7-figure threshold when I was around age 32. So call it 10 years out of school, 10 years of working, pretty good market running up to that. It wasn't like we were making, buckets of money through that time. and I probably should have mentioned this before. The first 5 years that my wife and I were married, we were both working. She was a school teacher, and I had just gotten started in my career. And then when we had our son, about 5 years into marriage, my wife's been a stay-at-home mom ever since, until about 2 years ago when she started dabbling in some travel agent stuff, which that was a fun business to be in 2020, as you can imagine. Wasn't a lot of action going on there. So, but that's sort of where we started. It was probably about 10 years in. And as you can imagine, when you start thinking through the math of that, that involves some heavy duty saving. So we were living way below our means. And sort of the mentality we took into the marriage was, we knew we wanted her to stay at home once we had kids. So from day one, we were living off my salary and not spending a nickel of her salary. And, these were during the days when we were both making, let's say, 25 grand each, right? So we were living off half of that, saving the other half, because we knew that once we had children, her salary wasn't going to be there. So we just got started doing that initially. Learned to kind of, live that way early on. And then as my salary grew and my role expanded, and then she stopped working, it was not a problem for us to continue to live well below our means. So probably I would say we were 10 years into our marriage when we crossed the seven-figure threshold. And then when, you start doing the math on that, it was only a couple years later when the financial crisis happened. So we backtracked and fell under the seven-figure threshold for a short while there as the market was recovering from those losses, because practically all of our wealth was in the market at that point. So that sort of gives you an idea of how long it took us to get to the first million. Now, what I'll tell you, I kind of lost track from there until probably about 3 years ago. But I would tell you that for the last 3 years or so, you're talking about growing wealth by something pushing seven figures a year for the last 3 years, as the market has done quite well, and as our primary residence has increased in value by a fair amount every year as well. So the pace is, hugely accelerated the last 3 years or so, which I do not anticipate that continuing over the next 3 or 4 years. But it just gives you sort of a flavor of that first million, and then how quickly the fifth, sixth, and seventh came on the heels of this market and the increase in value of the primary residence.
Totally. When did you decide to buy that $1 million primary residence?
Yeah, so we've been in this house almost 7 years. So that would have been when we were just around 40. Kids were obviously quite a bit younger then. We lived in a great area before that, but just decided with some of the development that was going on around us that we wanted to move out into an area that was probably a little further out, a little safer from future development, a little more land and a lot more space. So moved into a very nice neighborhood, and we're able to build on our own, and have been very pleased with that. Obviously, as you guys know, the Nashville area in general, and this area that we live in Franklin, Tennessee, and Williamson County is, probably ranks in the top 10 in terms of, property value increases over the last year or so with all of the COVID impact there. So we've greatly benefited from that, at least on paper. And not sure exactly what we'll do in terms of staying here for extended period of time or downsizing. We'll kind of see how that goes.
And how fast did you end up paying that off?
Yeah, we actually stockpiled cash in the years leading up to that purchase, and we paid cash for the construction. We took out a mortgage on this one. Although I will say, let me backtrack on that. We took out a home equity loan to pull the equity out of the home that we were living in before this, in order to fund the first few $100,000 of this build, and then replenish that as we sold that other residence. But we've never had a mortgage on this house. We ended up stockpiling cash to pay for that leading up to the build and through the build.
But you put $1 million in that.
We did. Yep. Just over $1 million, including some of the renovations and pool addition, things like that have gone in post construction. We got just over $1 million in, and then we cash flowed that.
So was that a hard decision or easy?
It was. Well, I would say it was hard intellectually, because I knew what else could be done with those funds as we were working through that. But emotionally, not hard at all. I have been I guess as close to a Dave Ramsey disciple, at least in the early days of our marriage, as you could be. So we've never really taking on debt. We did have a small mortgage on our very first house, but when we bought the second one, we ended up paying cash for that one. And then when we moved up significantly into this one, we decided we were going to do the same. So I am pleased with that because it's just one less thing. It gives me a little more peace of mind as I do start to get to the age where something like early retirement starts to feel a little more realistic, not to have that, the thought of a mortgage hanging over my head. I'm pleased with that. Now, when I think through what that money might have done in the market over that time period that it's been in the house, that's where the intellectual part of you and the math part of you might come to a different answer. But emotionally, I've been pleased with that decision.
How often do you look at your finances or calculate net worth?
Yeah, I am a big personal capital user, which, the upside of that is it's so easy. Like once I've got everything linked, it's, literally open it up and it links it for you and it's done in 5 seconds for what I used to spend, hours trying to tabulate on a spreadsheet every month or whatever, just to kind of keep up with how things are going. So that's been a huge blessing and a much more efficient way to stay on top of things. The downside is because it's so easy, I can open up the thing every day, and I probably do
multiple times a day.
Right, and I probably do open it up every day. Now that I say that sounded kind of funny, but now that I think about it, I probably do open it up every day. Now I don't take action on it. I don't do anything with it. It's just let's see what happened today. The market was way down. Wonder what the impact was there. And I'll open it up, look at it, and go on about my business. So I'm not I don't fret over it or try to outsmart it or anything like that. But I stay on top of that quite frequently. So at any point, if you were to ask me, hey, what's the net worth looking like now? I could probably give you an answer that was correct as of, a week ago. I'm probably on top of it enough to have something that's as recent as a week old because it's just so easy. I love that tool.
Right. So about 5 million in the market. Is that right? Across all the accounts?
Correct. Yep.
So what's been your biggest single day gain or loss? Do you remember?
Oh, wow. Oh, that's a good question.
I'm just thinking of those days like March 2020 or April, those, where it was down. Yeah,
those 10% down days were, multiple hundreds of thousands down, right? When you think about how much was in equities, you're talking about, quarter million down in a day in those crazy days. So, that takes some guts to stick with it at that point. And I will say that what I did at that time was that's when I actually moved some money out of fixed over into equities because I thought this can't last forever. I'm going to take advantage of this. My mistake was then as the market recovered or partially recovered, even halfway recovered back to where it was pre-COVID, I moved a bunch of stuff out. I said, okay, cool. I've covered my losses. Now I'm moving it out. And it was nowhere, near where it was pre-COVID. And I did not take full advantage of the run-up that we've had since then. But that at least allowed me to, to feel like I had recouped my losses a lot more quickly than I otherwise would have.
Right. So what are you going to do with all this money?
That's a good point. We're not going to spend it all. You can't come to that realization, and then that's when you start pivoting toward trying to get some help thinking around legacy planning. So I do believe that I will retire early. I do believe that our lifestyle will not change all that much, at least in the early years of retirement. So trust me, we will burn through a fair amount, just sort of living our normal lifestyle that we've created for ourselves. And, at least in the early years of retirement, my wife's got quite a long wish list of vacations and things once the kids are gone. So I'm sure that'll eat up a fair amount of it as well. But at this point, there's going to be money unless something, unbelievably unprecedented happens. There's going to be money that's, that ends up in the hands of the kids. And now we sort of pivoted toward trying to make sure that we've thought through the best way to do that and making sure that we're spending the right time and energy around helping them be ready for that. Because I know all of the stats around how much wealth, doesn't make it through the first generation. The last number I heard was 70% and 90% is gone by second generation. So we do not want to be that kind of family. So I want to use this to change the family tree. I want to do it in a way that the kids don't, become lazy and they're not going to be trust fund babies. That's not going to happen around here. But I do want to set them up for success with it and make sure they understand that they then have to shoulder the responsibilities and it works its way on down. So that's where a lot of our time's been spent. I'd say even over the last year or so with all the craziness going on with the pandemic and things like that, it's sort of brought me to that realization even more. And we've done quite a bit of work around estate planning in the last year to try to position ourselves for that.
Yeah, that's great. So let's talk career a little bit and management. I mean, we talked at the beginning, 25 years, right, in the same position. As you look back, and also you mentioned you were really Dave Ramsey disciple at the beginning and just living off your wife's income. Are you happy with how you had your work-life balance? Do you wish you would have spent more in the beginning and enjoyed more time, or are you happy with how that played out?
Yeah, I have no right to complain about anything, but in retrospect, we could have been looser early on. And I don't know that would have been the wise thing for us to do the first, 2-3 years of marriage as we were getting our legs underneath us, because you set patterns and create muscle memories there that I think have been very good for us. But it's sort of that, 5 to 10 year window, or even 10 to 15 year window when the kids are still young, and we still had our fun. We still did the Disney vacation and did all that, but sort of the I call them the daily luxuries. We didn't run around and go out to eat all that much. We didn't, take the kids and splurge on movies and museums and all that as much as we obviously could have, given, how you look at things in retrospect now. So again, hopefully those have created the right paths and the right muscle memories for our kids as well, to understand that, you gotta create a little scarcity yourself in order to position yourself the way you want to be long term. But we could have been looser then. So I'm very happy that we never took on debt early on, because we just never had that mess to clean up, and know so many people who, have spent years cleaning up those early mistakes. So really, really happy that we didn't enter into that. Our problem was probably more on the other side. Probably could have loosened up a little bit more, a little earlier, and changed the quality of life, more than the little bit of money that it would have cost us to do it. So, had to do over, probably would do that a little bit differently.
Did you worry about money in those early years?
Yes. In the early years, absolutely. And that was really the push toward living off one income, knowing one was going to go away. And at that point, I'm the wet behind the ears, 22-year-old right out of college, really no idea what my career trajectory was going to be. So at that point, I'm generally pessimistic by nature. So you start thinking, well, this might just be my salary for the next 15, 20 years, and we want to have kids. So the only way to make that work is to live pretty lean. So absolutely, worry might be a little bit of a strong word, but it was definitely something we thought about, were cognizant of, and we, like I said, created that sense of scarcity for us, and sort of took that probably further than we needed to, but definitely spent more time than most, I think, thinking about those things early on.
Yeah. The financial advisor, did you always use one, or is that new, and how come you use him now?
Yeah, that is, not new in the last, 2 or 3 years, but in the last probably 10 years. I think so. Multi-million threshold, I think, is when it hit me like, okay, I probably got to get some advice here. I wasn't too scared before that, but it got to the point where I thought I probably needed some help. So we have an individual who helps me think through overall asset allocation, but he understands that I am I'm a do-it-yourself kind of guy, and have continued that to some extent. I'm also an index fund, high level allocation, but index fund investing, low expenses. I don't try to beat them. I'm not trying to find the needle in the haystack. I want to own the whole haystack, and that's my mentality. And he knows that. So we talk about high level allocations, but I'm not looking for stock pickers. I'm not looking for managed funds. So some of that value that he might be able to bring to some of his clients, I'm not really looking for. So we got a good relationship in that kind of helps him with overall framework. I execute a lot of it myself through the, my directly owned Vanguard and Fidelity accounts. But that probably goes back about 10 years.
Okay. So let's talk about, we mentioned a little bit before we started recording, but the FDIC story. Tell us that.
Yeah. So this definitely qualifies as my biggest money mistake, because at the time I thought it was going to be about $150,000 mistake, which kept me up one night as I came to that realization. But pre-financial crisis, I had consolidated a few different savings accounts into one particular bank who happened to be offering the best online savings rates. It was a bank named IndyMac, and for those who are familiar with all the stuff that was going on during the financial crisis, you'll recognize that name as one of the names of the banks that didn't make it. So as some of the banks were going under and not able to cover all the deposits, IndyMac happened to be one of those. Some of the listeners will probably also remember that FDIC coverage limits at that point were $100,000 per depositor, per bank. And I thought I had structured this account in a way that we had double that because I thought I had it set up in a joint account. Well, we didn't. It was in my name. So we had one person's 100,000, the other 150,000 or so above that one day just disappeared from the account because it wasn't FDIC insured and the bank went under. So lots of has happened after that as, some of the bigger banks stepped in and gobbled up some of the smaller banks and took on their deposit liabilities and that sort of thing. IndyMac was not in that wave. They were one of the few that initially didn't have a bank that sort of stepped in and covered their uncovered deposits. So about a year or a year and a half went by before there eventually was legislation passed where some of the, call it the bailout if you want to, some of the bailout ended up covering depositors who had amounts on deposit in excess of the FDIC limits, and IndyMac was part of that solution. So luckily, that money did eventually come back to me, and I had already written it off thinking there was no way they were going to retroactively make changes to that. But with all of the other bailout funds that were sloshing around at the time, I guess they decided it was fair to sweep those banks into it as well. So yeah, almost 150,000. And that really, when it comes down to it, it was basically a paperwork problem. I did not follow through on making sure that account was set up as a joint account. Therefore, I had a lot more exposure than I thought I did. And wouldn't you know it, the bank that I had the money on deposit with didn't make it. So that was a sleepless night. It worked out okay in the end. Yep.
Yeah. So did you just log into like your online banking portal one day and the value was gone?
Yeah, it was, I think I saw the article saying that they were, that a few of the banks were in trouble. I think IndyMac was maybe even mentioned the next day. You start seeing the articles that IndyMac's closing its doors, can't cover the deposits, and, immediately look at the account and the balance is just gone. So, that was a bit of a shocker how quickly all that happened that was on the very front end of a lot of those bank stresses that were going on. So lesson learned. Now, since then, the FDIC limits, I think, they're either 200 or 250. Don't quote me on that. Somebody can look that up. But I think they're much higher than they were back then. So lots of changes in that space since then. But that was a pretty boneheaded mistake on my part that almost cost me a fair amount.
Wow. So let's talk advice here, Adam, and then we'll wrap up with some rapid fire questions. But I think you shared some good financial advice and life advice, and maybe hit on landlording. I mean, we have a lot of our millionaires are landlords or own other real estate. You mentioned you don't. So just share some general advice here.
Yeah. So I have actually, we'll start with the landlord thing. I have thought about that from time to time, have never pulled the trigger, and I have no interest in being a long distance landlord. And now with property values as they are around here, I think that ship has probably sailed. I don't love the idea of the hassle of involved in that. Not to mention that a high enough percentage of my own personal net worth is tied up in my own personal residence that I feel like I got plenty of exposure to real estate already. So I don't know that I'll ever venture into that space. I know lots of people do very well at that, but I frankly don't have the time or energy to spend on, I think, doing the homework needed to make sure I'm getting it right on the front end and manage it. I'm so cheap that I wouldn't hire a property management company. I would want to be doing all that myself. And I think I know myself well enough to know that I'd be getting it over my head there. So I have never ventured into the real estate space. My advice really would be, you don't have to be super creative or take unbelievable risk or hit the lottery in order to build the kind of wealth we're talking about here. Everything that we're talking about here was built on a solid job, one company, 25 years. I've done very well at that company. That company has been great for me. But this is just spending less than you make and investing the difference and doing it all the time, no exceptions. So that's been the mantra we've used for 25 years, and normal people can do this. Yes, people are going to have incomes that vary. Not everybody's going to have the same level of income I did, but everybody can do every other thing that I did. And whether you got the same income level or not, you can get to wealth levels that will surprise you if you just start this early on. So Only other thing that I would probably mention, this is a regret on my part as well, now that I'm to the point where I'm starting to think a little more about taxes and, once they become a little more controllable in retirement. I have not done a good job at all and didn't do a good job early on taking advantage of Roth accounts. So of the, $1.5 million or so that I've got in retirement accounts, there's only about 100,000 of that's in a Roth account. So every bit of the rest of it is going to be, taxed at taxable income levels when it comes out. And I think early on, I was probably a little penny wise and pound foolish, probably should have shoved more money toward Roth. And then obviously as my income has grown now, it makes much more sense to get the tax deduction now, because I think I'll actually be in a lower tax bracket in retirement than now. But I could have done that differently early on, and years of growth in the Roth accounts for the first 4, 5, 6, 8, 10 years that we were married would think have put me in a much more diversified tax situation than I'm going to be in now heading into early retirement. So that's just another thing that I would mention to people. It's always nice to get the tax deduction at any point, but the tax deduction is material enough that you're almost forced to do the normal 401k. Early on, when you're not making that much money, swallow it and do the Roth would be my advice to people. Just go ahead and pay the taxes. It's a lower rate than you'll probably ever pay for the rest of your life. Get some money in Roth early on. You can always pivot the other direction as your income and tax burden goes up.
Adam, to that point, being on this path to potentially retire early, do you think you'll do any Roth conversions, given that y'all are still pretty frugal and won't be increasing lifestyle or anything going forward?
Yeah, I do. I definitely think that window between, let's just use 55 hypothetically, 55 and 72 or whenever we got to start taking it out, I definitely plan to do Roth conversions in there. The investments themselves throw off a decent amount of dividends and income, capital gains distributions, and those kind of things. So it's not like we'll have zero income when I enter retirement. There will be some taxable income coming through, but that's still going to leave me, in a very manageable tax bracket. So I'm looking at, do the math there. It's 17 years worth of a reasonable level of Roth conversions between 55 and when the distributions become mandatory. I think I can start to chip away at that some, and I've just sort of come to the conclusion that I'm going to do that. Now, obviously, with all of the tax discussion that's flying around now, maybe something will happen that'll change my mind on that, but that's certainly in the plans for now.
Totally. Do you budget at all?
So you'll laugh at this. We do not. Now we did early on, and we did for a long time. We don't anymore. We sort of fallen into the pattern where I'm not frankly sure it would do us a whole lot of good anymore. And it's this is going to sound awful, but it's not worth the trouble for me anymore, because if we overspend by a few $100 a month or something, I don't worry about it anymore. I did when we were first getting our legs underneath us. So we haven't budgeted in a while. Every once in a while things will start to creep up, and I pay attention enough that I will notice, and we'll have a conversation, and we'll get back on track, and that's just sort of it. And we'll move on, but it's less, it's done less from a close monitoring and more of that number was a little higher last month than I expected. What's going on here? I hope we're done with that. We need to get back on track. That's good enough for us for now. Seems to work okay, and we've kind of relieved some a little bit of the discipline around that as things have loosened up.
Totally. Well, let's wrap up with some rapid fire questions. What's the most expensive meal out you've personally paid for?
Ooh, so I've personally paid for a meal for the folks who reported to me at one point that was probably in the $700 range for 4 or 5 of us, which probably doesn't sound extravagant, but that's about the outside of my comfort level.
Okay. What's been the most expensive vacation you've been on?
Oh, that's a good one. So,
or entertainment, if you went to a concert, maybe.
Or entertainment, yeah. Vacation is probably the better one. It's so a couple of years ago we spent almost 2 weeks in Europe with the kids. So spent better part of a week in Rome, and then did a Mediterranean cruise. So I don't remember I frankly don't remember how much we spent on that. It wasn't ridiculous. It was probably, but it was probably, it was probably $10,000 or something. So by my estimation, that's an expensive vacation. That'll give you some idea of what the outer fringes of our luxury items are.
Yeah. What's been the most expensive car you've purchased?
So I still have it now. I still drive my Tesla. I was on the early adopter curve of the Tesla Model S. So I'm almost 6 years into that. That's definitely the most expensive car that I've ever bought.
Okay.
How much have you spent on repairs on that?
Almost zero. So I think I've had, you guys will think this is funny. The repairs that I've had to do on my Tesla, I've had to replace the little 12-volt battery, like the little battery that runs the electronics in the car, not the battery that runs the car. That thing tends to go out every once in a while, and it's a couple $100. So I've had to do that 2 or 3 times, and that's about all the money I've put into that car. It's been great.
Wow, that's awesome. And tires aren't too bad either.
Not too bad. I'd probably drive it a little less aggressively than most Tesla drivers. So I'm not burning the rubber quite as much as most, but not terribly frequently. Not a whole lot more frequently than the other vehicles I've had. So it's been a great car. I'm going to hang on to it as long as the juice is still flowing.
Totally. What has been the range of annual household income through your working life as much as you're comfortable sharing?
Yeah. So when we first were both working, I think I mentioned earlier, we were probably making somewhere, I think we were in the $25,000 to $26,000 ballpark a piece. So we were in the $50,000 range when we first were married. And now remember, that was light years ago. It was back in 1996 or whatever. So that's been a long time ago. Current income it's been in the 400 to 450 range. And that sort of combines, my salary, bonus, stock awards that vest every year, things like that. In addition to some dividends and interest that the investments throw off. And actually the last couple of years, as my wife has been doing some travel agent work, she's been adding, a little bit to that income as well. And it's keeping her busy. So that's been a very good thing for her as well.
How many hours a week do you usually work?
Ooh, so I would say for probably 7 to 8 months of the year, I can get my job done in a normal 40-hour week. We have a busy season, as probably most jobs do, that lasts 4 or 5 months, and those weeks can be pretty long. So I'm probably closer to the 55 to 60 hours a week during good portions of those of those busy season months. So I work a fair amount. It's a job where you're kind of on call all the time. So, I'm up early working, I'm working late. I'm not a slave to my laptop all day long. So there's plenty of flexibility within this role, but it's pretty heavy, pretty demanding role.
How many hours of TV a week do you watch?
Ooh, that's a good question. So more now than I probably ever have, because the kid, I've found as the kids get older, they don't need me for much anymore. So there's a baseball game on just about every night. But, at some point when I decide to sit down and watch a little bit. So on average, including weekends, I probably watch 8 or 10 hours of TV a week, and probably 90% of that is whatever sporting event happens to be on when I sit down.
Do you have hobbies that you spend money on or spend time on a lot?
Yeah, we do not. We're not big golfers. We're not big, fill in the blank. We don't have a lot of hobbies. So now we're charitably inclined. So we're active at our church and give a fair amount, to the local group that we attend, and look for charitable opportunities outside that as well. So we spend a lot of money on charitable contributions. But really, hobbies, there are almost none. My wife's hobby is traveling. So we take our, 2 or 3 vacations a year and spend a fair amount that way. Beyond that, not much.
Well, Adam, you've been on a tremendous journey, and congrats on your success. Once again, that's Adam with a net worth of $7 million. Thanks for coming on the show today.
Yeah, thanks for having me, guys. Enjoyed it.
Thanks, Adam.
Thanks.
Thanks for listening to the Millionaires Unveiled podcast with Clark Sheffield and Chase Mattinson. For more stories, investment opportunities, and information, check out our website at millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.